Japan just broke another record. Its overseas assets, the money it has stacked up in foreign companies, bonds and loans, hit an all-time high of 13.4 trillion at the end of Nisen R 10. That is the 8th consecutive year Japan has broken its own record. 8 years in a row.
And Japan still fell to third place. For 34 years, Japan was the world's largest creditor nation, the country with more money invested abroad than any other. In Nessendesh, Insifi Germany took that crown for the first time since Sin Chubik Yuidin. Then in Nessendesh, Insifi China leapfrogged Japan too. Japan is now number 3, sitting behind Germany's Sindesh Insishubik Yuidin, and China's Sindesh Insishubik Yuidin.
Here is the paradox. Japan has more money overseas than it has ever had in history, and it still cannot hold on to second place.
Understanding why this happened, and why the answer is more interesting than the headline, tells you something important about how money actually flows through the global economy.
Let us establish exactly what these numbers mean. A creditor nation is not about how much money a country has in total. It is about net external assets, what you own overseas minus what foreigners own in your country. It is a balance sheet, not a bank account.
Japan's gross external assets are enormous, 1,800 trillion, roughly 11 trillion. But foreigners also own a lot of Japanese assets, as foreign investors have poured into Japanese stocks, real estate and bonds. Japan's liabilities have climbed too. Net of those liabilities, Japan's true figure is hugap luxitin pachien trillion, or about santingodol trillion.
Germany sits at Yupai Oyen Frillion trillion. China at Yupai Senju Loktian Senyen trillion. Japan's Yontian Yon% year-over-year growth is solid. But Germany grew faster. China grew much faster. Japan is not shrinking, it just has extremely fast competition.
Germany's rise is relatively straightforward to explain. Germany runs one of the world's most persistent trade surpluses. In Warsen 4, its current account surplus hit Warsen 4 billion, roughly Warsen 4. Every year Germany exports more than it imports. Those euros need to go somewhere. They flow out as investment, German companies buying factories in Eastern Europe, German pension funds snapping up US corporate bonds, German banks lending to Southeast Asian infrastructure projects.
There is another factor that rarely gets mentioned: the euro. When the euro appreciates against the yen, which it has done substantially, Germany's overseas assets look even larger when converted into yen for ranking purposes. The methodology rewards currency strength, and the euro has been stronger.
Japan, meanwhile, has been fighting a structurally weak yen. That same weak yen inflates the yen-denominated value of Japan's overseas assets when you look at them from the outside. But the ranking is calculated in yen, so a weaker yen actually suppresses how large Japan's assets appear in the global comparison.
The irony is precise: the same weak yen that makes Japan's exports competitive and inflates the yen value of dividends coming home actually hurts Japan's ranking in creditor nation tables.
China's rise to number 2 is a different story entirely, and a more geopolitical one. China has been running enormous trade surpluses for over a decade, particularly since the pandemic. Its goods surplus with the United States and Europe has been compounding. That surplus has to go somewhere, and Beijing has been deliberately routing it outward through the Belt and Road Initiative, state bank lending, and direct investment in resource sectors across Africa, Latin America, and Southeast Asia.
Since China's cumulative overseas investment and construction through the Belt and Road alone has reached 1.4 trillion. In 2025, new BRI engagement hit a record 1.4 billion in a single year.
There is a structural difference between Chinese overseas assets and Japanese ones, though. A significant portion of China's overseas position consists of sovereign loans to developing countries, loans that carry geopolitical conditions and which have been going sour. Several major BRI debtors have restructured. Beijing's claims on these countries count as assets in the statistics, but collecting on them is another matter.
Japan's overseas position is overwhelmingly private sector Japanese multinationals running profitable operations, Japanese institutional investors holding US treasuries and European equities. The nature of the assets is completely different. One is a web of factories, brands, and financial investments. The other includes a significant share of state-directed loans to risky borrowers.
Here is where the ranking obsession misses the point. As we explored in episode Wugs, Japan's overseas empire is not primarily about how big the balance sheet looks. It is about what those assets produce every year.
Japan's primary income from overseas investments, the dividends, interest payments, and profit repatriations flowing back to Japan, hit 6.3 trillion in fiscal year Nisen ish Wutan 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 fade.
Japan's current account surplus, driven overwhelmingly by this investment income rather than by trade, hit a record high for the third consecutive year in the fiscal year ending March Nisennishluk Sanju Yoten Wuen trillion, or about Utak Sur Kundol billion.
Japan earns more from its overseas empire every year than most countries earn from everything. Germany's trade surplus generates assets, but it does not yet generate the kind of steady income that a century of accumulated global investment creates. China's BRI generates claims, but many of those claims are non-performing and the income they generate is thin.
Japan lost the trophy, it kept the income. According to Jetro's Nisen Arsavul survey of Japanese companies operating abroad, Lux Lukdan Wu % of those companies expect to be profitable this year, the highest figure in years. Japanese companies are quietly operating factories, hospitals, logistics networks, and financial institutions across HGR countries. That operational income flows home every quarter, supporting Japan's current account, the yen, and ultimately the Japanese standard of living.
None of this means Japan should be relaxed about falling to third. The gap is widening. Germany's current account surplus is structurally larger than Japan's. China's overseas position is growing faster, even accounting for quality differences. If current trends continue, Japan could find itself at number 4 within a decade, possibly behind the United States, which is a net debtor today but has been gradually improving its balance sheet.
There is also a domestic pressure building. Japan's working-age population is shrinking. The country earns enormous income from abroad, but increasingly needs to use that income domestically rather than reinvesting it globally. As aging demographics force Japan to draw down its overseas savings, as retirees cash in investments to fund consumption, the net asset position will eventually start declining.
Japan has been in surplus on its net external balance for so long that it is almost impossible to imagine the alternative. But Japan's neighbor South Korea only became a net creditor relatively recently, and countries can lose creditor status faster than they built it.
For now, though, the Japan factor insight is this: the ranking tells you about the size of the balance sheet.
Japan may no longer have the largest pile of overseas assets, but its pile is working harder for longer than any rival. The creditor crown changed hands. The creditor income machine did not.
Japan's Ministry of Finance net international investment position. Data for End 2R was released in May. Nisen ni Lukden. Germany and China figures sourced from Bloomberg and Japan Times reporting on global creditor nation rankings. Primary income figures from Japan's Ministry of Finance balance of payments. Data. Fiscal year Nisen Wasin JTROFY Nisen Wasin. Survey on business conditions of Japanese affiliated companies overseas.